Good morning, everyone, and welcome to Technical Analysis using the Nadex Indicators A to Z Part 2. Now, before we get started, I would like everyone to take just a moment to read over the Nadex risk disclaimer. It is for your protection as well as ours. And basically, anytime you are trading, there is risk involved. And you should never trade with money you cannot afford to lose. Now, to get started this morning, I just want to introduce myself. My name is Gail Mercer, and I am the founder of Traders Help Desk. I have more than 15 years of trading experience. I actually started out with a company that programmed indicators and really just fell in love with the price bar the moment I saw it. I do specialize in price action, volume analysis, and divergence because I believe they are leading indicators. I'm also a frequent contributor to Stocks and Commodities, Traders World, and Top Shelf. I've also been a speaker at Traders Expo, Traders World Online Expo, and the Wyckoff Volume Conference. I'm also the author of Trading Nadex Binary Options and Spread using candlestick patterns, Trading Nadex Binary Options using currencies, Trading Nadex Binary Options, Keeping It Simple Strategies, as well as the New Trader's Guide to Trading Nadex Binary Options and Spreads. Any of these books can be purchased on Amazon. Now, today we're going to be going through the indicators N through Z that Nadex has on their platform. So, good morning, Edward. The first one I want to start out with is the MACD. Now, the MACD actually stands for Moving Average Convergence Divergence. It is a very simple indicator to use. It is considered a trend following momentum indicator. It uses 3 exponential moving averages. The MACD line is actually the difference between the first 2 exponential moving averages. Then your signal line is the third EMA. Now, your typical entries on the MACD is you generally will buy when the MACD line crosses above the signal line. You will short when the MACD line crosses below the signal line. Okay? Very, very simple indicator to use. Now, there's also a momentum indicator. Now, to me, the momentum indicator is a little bit harder to use. And the reason it is you're combining price action with divergence with the momentum. So you have to kind of combine 3 different techniques into one to use it efficiently, in my opinion. Now, it does do... Can everyone hear me this morning? Someone's complaining about not having sound. If you can type in a yes if you can hear me this morning. Okay. So what the momentum indicator does is it actually averages the closing prices over the last X number of bars, okay? And then it will show you if the momentum is to the downside or the momentum is to the upside. Then you can combine that with, for example, in this chart, you can see that price came back and tested the low over here. And when it did, the momentum indicator actually was higher than it was on the low. That's called divergence. So this is why I classify this as a harder indicator, because you really do need to combine techniques to use it, okay? Any questions on the momentum indicator? Now, you know, I guess you could say, okay, whenever it's green, I'll go long. Whenever it's red, I'll go short. Typically, you would want a little bit more than that, okay? And that's the reason I said you would combine it with the price action and the divergence indications. Now, the next one is a moving average. In moving averages, there's a couple of different types of moving averages. And we went over the exponential moving average last week. with the week before. This one is just a simple moving average, okay? Now, in this case, there's 3 moving averages that are combined into this one indicator, okay? The shortest length is considered the fast moving average, and that would be the green line on the chart. Then your middle length is considered the medium term moving average. So that would be this black line. And then the longest length is considered to be the slow moving average. That would be this red line. Now, if you did not know that, if you look right here in the lower left-hand corner of the screen, do you see how it says MA 20, 50, and 100? So 20 is in green. That tells you it is the fast moving average. The 50 is in black, so that's your medium term moving average. In red is your slowest moving average, also the highest number. Does everybody understand that? Now, what would your typical entries be if you were using this type of moving average? Well, let's say that the slow in the medium is below, no, the fast in the medium is below the slow moving average, okay? That tells you you would only want to consider short positions. Or if the fast in the medium are above the slow, then you only want to consider long positions. Then you could actually refine that just a little bit more and say, okay, all of the moving averages have to be going in the same direction. In other words, they all need to be going down, okay? And then price retraces back to a moving average. Then you get a bearish bar for short position, or you would get a bullish bar for a long position. Does everybody understand that? Any questions on the moving averages? They're really simple. Sometimes you might want to use like a 20, a 40, and an 80. Some people use a 50, 100, and a 200. Mainly what numbers you put in there is more concerned about, what type of trading are you doing? Do you want to stay with it for the duration of the day? Okay. Or do you want to just take a little piece of the action? In other words, instead of trading a daily binary, you might be trading a 2-hour binary. Bar, yes, a price bar is one candle. Okay. Any other questions on that? Okay, now the parabolic SAR. Parabolic SAR, the SAR stands for stop in reverse. Okay. That's the easiest way for you to remember. It's really very, very easy. Okay. A bullish parabolic simply means that the dot is below price. It works a lot like the ATR stop that I use. A bearish is a dot above price. So here you can see that it's bearish versus here you can see that it is bullish. Now, after entry, okay, the dot should always begin to rise or it should begin to fall, okay? The best scenario or the best example is where it turned red here. And do you see how immediately it started falling? That's exactly what you expect with the parabolic, okay? If you have a parabolic and it starts to move up and then it flattens out, then that tells you you may want to either, tighten a stop, or you may consider taking profits because the parabolic should not be going flat. It should actually be moving down with price or moving up with price. Does everybody understand that? Now, personally, my favorite entry, if I was using the parabolic, would be right here. Let me get my little pen going. My favorite would be right here. Do y'all see that? Where it comes really close back to the parabolic, then forms a bullish bar, okay? And the next bar closes above the high of that, which makes it a pivot low. That would be my favorite entry right there, okay? And, you know, you could use an out of the money. Yes, it's on the pullback, Lindsay. You could use an out of the money binary. You could use a call spread. You could use a touch bracket. I mean, we have all kinds of different ways to trade it, okay? But that would be your entry point, okay? Now, it does use risk to reward parameters, okay? And the reason it does that is because, like, for example, over here, okay, let's say that you went short here, okay, then you may want to stay with that until this point here when it flips the parabolic, okay? Any questions on that? And this would be considered your trend run. So, you know, the theory behind that is the same theory that I teach a lot, in that, okay, if you were risking this much, and I'm going to draw these lines out a little bit more, okay, this was your entry, and let's say this was your risk, then, you know, if you went here and got out, this would be your profit, correct? Well, look at the difference between your entry and your profit versus your entry and your risk. Do you see how small this is compared to what this is? That's what risk to reward is all about. Okay? Because this move right here will compensate when you do have the losses. So this is one reason I like the parabolic. It kind of teaches you need to have more on the reward side, which is your profit side, versus your risk side. Everybody understand that? Any questions on that? Now, again, this would be your goal, okay? But again, as I've often said, you know, your job is to take profits, okay? So you don't let your profits slip away. You can't be so stringent that you go negative just because it didn't hit, you know, a 1 to 2 risk to reward ratio or 1 to 3, okay? And I just want to make sure I clarify so everybody understands that. Okay, any questions on the parabolic? All right, pivot points. Pivot points are a support and resistance indicator, and I personally do love the pivot points, okay? And all it does is it plots what's called the floor trader pivots from the prior day. So it basically will take the prior day action and it will plot where the support and resistance lines are. The pivot point, which is this line right here, is considered like the midpoint of the pivot points, okay? If price is trading above the pivot line, then typically you would consider that an up day. Or if it's trading below the pivot line, it would be considered a down day. Now, it can reverse at any of the pivot lines. For example, the S1 line, price could come down and it could offer support and then it would start to move up. Or it may test the pivot line and then move back down to S2. The one thing about it is when you do see that it's moving at S3 or R3, that's what I would consider a super trending day. So typically, if it is trading above R3, I do not mess with it. If it is trading below S3, I do not enter the market, okay? Because these are what I would consider super trending days, but they can also reverse against you very quickly. Any questions on the pivot points? Pivot points are really easy to use if you know candlestick patterns, because that's what you're looking at the candlestick pattern, okay? you're looking specifically, are they rejecting this area, or are they saying, oh, no, this area is not going to hold, and then they break through it? Does everybody understand that? Any questions on the pivot points? It's really one of the oldest type of indicators, in addition to the moving averages, I think, that are used on the markets today. Yes, all of these are on the Nadex platform, every one of them. And in the coming webinars, I'll actually zero in on 2 or 3 indicators and how to design a trading plan using these 2 or 3 indicators. We'll be doing that, I think, one in February, and then we'll have a couple of them in March as well. This is meant to be an overview, because what I want you to do is kind of review the video and say, well, which one actually makes most sense to me? Okay, and those are the ones you want to zero in on. If you see one and say, oh, that doesn't make any sense to me at all, that's probably not the indicator you want to use. Okay? Any other questions on the pivot points? Okay, let's go to the next one. And the next one is the RSI. Now, I label the RSI as a hard indicator, okay? But it also depends on how you are using it in your trading, okay? It is considered a momentum indicator, okay? And if you're just using it to identify overbought and oversold levels, then it's pretty simple, okay? If it is above 70, it would be considered overbought. If it is below 30, it would be considered oversold. So in this case, if you saw that it was oversold, you say, oh, okay, it's oversold, I'll take a long position, okay? That would be very easy in itself to do. However, most of the time, you don't want to just take a trade because it's overbought or oversold, because it could be overbought or oversold for extended periods of time. Okay, what you are probably better off doing is looking for divergence. Okay, so for example, in this one, you have prices making, a higher high here. Okay, and when you come here, it's actually making a lower high at this point. That's one type of divergence, okay? Then if you look here, you were making lower lows, but higher lows in the stochastics. Again, there's your divergence, okay? So, combining it with the divergence, I believe, will give you a little bit of an edge if you're using the RSI. Now, the other thing about the RSI is it does not do very well in choppy markets. Does everybody understand what I mean by a choppy market? A choppy market means that the market is moving sideways. Some people call it consolidation. You're not making higher highs. You're not making lower lows. Okay. So if you're in that type of market action, the RSI is much harder to trade. Okay. Just a brief example of a consolidation is over here. You have a little bit of consolidation here, and you can see the RSI is just kind of doing this. It makes it very, very hard to actually trade that. What's the technical difference between the RSI and the stochastics? Well, there's not a lot of technical difference. They're both momentum indicators. They both identify overbought and oversold. It's the formula that is used to calculate both that is different, okay? Now, your stochastics, which I think is the next one that we're going over, is going to be better in both trending and non-trending markets. And some of that, you have to take into consideration that some of that is actually based on my perception of the indicators, okay? I don't think anybody can say with definitive that this is better than that. It depends on how you use it. I have used the RSI, and sometimes I combine an RSI with a stochastics because the RSI will measure the trend strength for longer than the stochastics. So when you get the stochastics and the RSI at the same point of being overextended, and I usually do that when they're trending markets, then you will, get a better retracement off of it. And again, you can use both of them at the same time, but generally your stochastics will give you a better reading because it does better in the choppy markets. Okay. Now, rate of change. Again, I consider this one a harder indicator because you do have to combine it with other techniques. It's not something that you would just put on your chart and start trading. Okay, it is a momentum indicator, very similar to the momentum indicator itself. Okay, it does compare the current price with the previous price X bars ago. Okay, and as you can see here, it's telling you, okay, the momentum is to the downside, but at what point do you enter this? Okay, and here it's telling you the momentum is to the upside. Okay, at what point would you exit or enter this? Again, this is where you're going to have to rely on your price bar formations and something like divergence that says, okay, this is probably ending or this is just the beginning. Okay. Now, there is also the standard deviations. Remember last week we talked about the Bollinger Bands? The standard deviation is encompassed in the Bollinger Bands, but it also is a separate indicator in and of itself. Okay. To me, it's very easy. It does measure the volatility of a market. Okay. Very similar to the ATR that I showed last week. Now, here's the difference. When markets are topping, okay, that means that they have made new highs and it's starting to lose that momentum. You will see the volatility decrease, okay? And when markets are bottoming, meaning that they're fixing to turn from the lows, then the volatility will increase. Yeah, it's because it goes opposite of what you think should happen. Okay. And the reason that I say that, Lindsay, is because most traders think, okay, if this is really topping out, then yeah, you're going to lose the volatility. And that's exactly what you see here. Okay. It had a high volatility over here, but then over here, it's even lower. Okay. Now, on the short side of it, okay, you start out really slow, okay, and then do you see how it expands here? Okay, that's what you expect when markets are actually bottoming out, okay, and that's what is very confusing to everybody. They don't expect to see that. They actually expect to see the reverse. Now, what I see with it, trying to trade it, sure, you were increasing up until about here, okay? But at what point is it actually going to start rounding over? Was it here? Was it here? Or was it here? Well, in hindsight, you know that it was over here because it dropped after that. So in this case, you might have had quite a few missed signals. But again, this is not one that I would trade by itself. This to me would be more informational, not this is going to generate my entry. Do you understand the difference between that? Let's say that I was thinking about entering, you know, somewhere around this line right here. Okay. And I'll say, okay, I'm going to enter a long position. I'm not going to rely on this indicator. But once I enter, then I might say, okay, does the volatility increase? Well, if it doesn't, then I might want to tighten my stop or take profits early. Is this a lagging indicator? Edward, I think every indicator you put on your chart is going to be a lagging indicator unless you know how to read the price bar with it, because the price bar is what's going to turn it from a lagging into a leading indicator. What are the considered ranges of high-low volatility plus or minus 0.005? It depends on the market and the time frame that you're looking at, KM. It will tell you if volatility is increasing or is it decreasing. In other words, does it still have a full tank of gas? It's the best way for me to explain it, okay? That would be the easiest way for me really to explain it. Do you see how here it's going up and this is going up too? Well, to me, this had a full tank of gas, okay? But then when it came back, it kind of lagged, okay? Now, either it was running out of fuel or it had trash in the gas line, one of the two. Is there a quick way from the indicators to identify when it is a missed signal versus an actual trend change or drop short term, like in a 5-minute time frame? I'm not sure I follow that question. The indicators themselves do not do signals as far as put an arrow on here that tells you, okay, this is where you go short. That would be an actual signal. An indicator, when you put it on your chart, you are the one that has to go back and look at it and say, okay, I understand this, and this is the point where I would enter a trade. It doesn't really plot an arrow on your chart for a signal. The indicator versus volume bars, I don't understand that question. And especially because we're going over Nadex indicators, there's no volume bars in there. If you wanted to look at volume, you need to go into another charting platform. No, this is price bars, and this is your standard deviation. Are you trading in Nadex? Yeah, Think or Swim does have volume, Lindsay, but not the Nadex charts. Okay. I meant, like, is there a quick way to assess without depth analysis when it's going to be a series of small directional changes, like in the beginning versus a solid drop? There are ways to do that, but it's beyond the scope of this webinar. And it's not one particular indicator you would use for that, but a combination of indicators. Okay, any other questions on standard deviation? Okay. You're looking at the underlying, Lindsay. And the volume is on Thinkorswim. Yeah. If you're using volume analysis, Lindsay, you have to look at the underlying. Because even if we did see the volume on the Nadex chart, it would be the volume for the binary option, not the indicative index. Any other questions on that? Now, the stochastics. Now, again, just like the RSI, the stochastics can be very hard or it can be very easy depending on how you use it, okay? Now, just at the most basic, the stochastics is going to identify your overbought and oversold levels, okay? Overbought would be above 80, oversold would be below 20. That is pretty simple. I typically do not just trade overbought and oversold. I like to combine it with other techniques like the divergences, okay? And again, if you're looking at divergences, one of the most powerful moves, and it is a momentum move, would be your hidden divergence, okay? So here you have made a high. Here you make a lower high, okay? That's your hidden divergence. In other words, price is going one direction. The stochastics is going another direction, okay? In this case, you made a lower high. This made a higher high. That's your hidden divergence, okay? If you come back to here, okay, you can see from here to here, you made a lower low in the stochastics, but you made a higher high here. Okay, that is one way. I love divergence too, Lindsay. I just love divergence. I'm a big divergence trader. Over here, you can see, okay, you made a higher high, you made a lower high right here. Okay, that's another divergence, and it told you that more than likely the market was going to go down. Now, when do I use overbought and oversold? Typically, let's just say that I was in this market here, okay? When I saw this, I'm taking profits. That simple. And, you know, it doesn't matter whether my binary is expiring or whatever. I'm taking profits because now I know, okay, this market is oversold. It's going to eat my profits. I'm taking them. Does everybody understand that? So this one, it can be easy depending on how you're using it. And generally, anytime it's overextended and I'm in profit, I'm either going to take my profit or I'm going to start watching it a lot closer. This one over here, again, it's a great example. If I was in from over here and then I saw that this market was overextended, I'm closing my position. Because what is my job as a trader? My job as a trader is to take profits. Okay? That's just using the overbought and oversold to lock in profits. Okay? Any questions on that one? Any questions on the stochastics? Now, the stochastics actually does work pretty good even in a choppy market. You can usually tell you're in a choppy market or a sideways market and still use the stochastics to trade it, unlike the RSI. Well, then we're on the same page, Lindsay, if you use it the same way. I love the stochastics. But there's times I also use the RSI, you know. They do have different purposes, and sometimes the RSI is what I need for confirmation, basically. Now, this is the other moving average. Now, we've gone over the simple moving average. We've gone over the exponential moving average, and now we have the weighted moving average. And the difference with the weighted moving average is that it still uses averages over X amount of period. You know, you can see here, this is a 20, 50, and a 100. The difference with this one is it's going to give more significance to this closing price versus this closing price versus this closing price. Okay? And that's your biggest difference. Okay? You will not see a big difference between the moving averages, but there are slight differences between them. What time frame does that technique work best in, of simply using it to determine when you should get out? You know, that's an open-ended question, because number one, are you trading a 2-hour binary? Are you trading a 5-minute binary? Are you trading a daily or a weekly? That's all going to determine your time frame that you use. Are you using a call spread? Are you using a touch bracket? All of this is different and would require, you know, a different time frame to use it. You know, I wouldn't use a 5-minute to get out of a daily binary, okay? But then again, I wouldn't use a 60-minute to get out of a 5-minute binary. So it really kind of depends on what you're trading and what time frame you're looking at. Which of these indicators work best with the new touch bracket product? Any of them. Any of them that you understand will work really good with the touch bracket. I've been trading the touch brackets a lot. And I love the touch brackets. To me, they're just fabulous. And I'm doing another webinar next week on touch brackets, KM. You may want to join that. And, you know, a lot of the questions in the room today are, you know, which indicator works best for XYZ? You know, what you should be asking yourself, which indicator looks and makes the most sense to me? And then your time frame is going to be dependent on what you are trading. Okay, are you trading a 2-hour binary? Okay. Oh, Lindsay, they're really easy to figure out. If you go to my YouTube page on my YouTube videos, I've done a lot of touch bracket videos recently, and sometimes I go live and show them. What's my favorite indicators and what do you use the most for yourself? Okay. I use the ATR in Stochastics. I also use intraday fibs that I designed. And I also use a trend support and resistance and a trend ATR. Okay. But again, I've been trading for 15 years. When I was doing the Traders Expo, and it was back in New York, and I was trading forex. We didn't have Nadex binary options back then. They were having a contest. Okay. And I didn't have my indicators with me. They had this platform, and they condensed an entire day of trading within a 10-minute span. And they did a contest, okay? And whoever could make the most money within that 10-minute span, and believe me, those charts were moving really, really fast, won the contest. So I put 2 moving averages, and I had my price bars, and I won the contest. Why? Because I understand the moving averages. You know, 50% of your indicators are based on moving averages. If you go back through the video that I did last week, if you go back through this video, most of these are averages, the same as a moving average. And I would be willing to say 50% of indicators out there are based on moving averages. Okay. All right. Then I combine the power of the candlestick charts. Okay. And I did an entire day's worth of data within a 10-minute span and won the contest against everybody else. Why? Because I knew what my plan was. I knew moving averages, and I know candlesticks. It does not have to be complicated for you to make money, but you do need to sit down and think out your plan. There is no right or wrong indicator. I can put any indicator on a chart, combine it with the price bar, and probably make money with it over time, not necessarily off of one trade. Oh, I love candlesticks. I mean, to me, if you don't know the candlestick periods, the candlestick patterns, then you're at a disadvantage. Do you agree that 20, 50, and 200 are the ones needed the most above all the others? Well, for that contest, I used a 10 and a 20. Typically, I use a 20, a 50, and an 80. Would you like to know why? Because the 50-period moving average is one that most traders use for intraday. But a 20-period is what I like. And then all of my time frames are typically multiplied by 4. So if I go from a 15-minute to a 60-minute, that means I used a multiple of 4 to get to my 60-minute time frame. Is everybody with me so far? So I have a 15 and I have a 60-minute, right? Okay. If I have a 20-period moving average over here on the 15, and I have a 20-period moving average on my 60-minute, what would be equal to that 20-period moving average on my 15-minute chart? 80. Because I used a multiple of 4. So I take 20 times 4 equals 80. There's no magical numbers here. You know, some days you're going to see it retraces to the 50-period moving average all day long. In other days, Lindsay, you're correct. It's going to be between the 10 and the 20. Now, what would be significant on the 200 JC is if price breaks the 200 moving average, then most of your professional traders would say, okay, we're potentially going into a downtrend. The indices just did that not long ago. And so it's got everybody on edge because they believe that we're going into a downturn on the indices. It's just the way you use them, okay? Which time frame are you trading, okay? It's going to make a difference in, you know, probably what your numbers are. Any other questions on that? Okay, now the William %R, to me, I also consider this one a harder indicator to learn. It's not one that I would want to use if I'm a beginner, okay? The momentum indicator identifies both overbought and oversold. That makes it easy. Overbought 80, oversold 20, okay? But again, you have to learn divergences with this. And I just find that the stochastics is better than the Williams %R. Now, there may be some of you in the room that say, well, I like the Williams %R better. Okay, then you use that one. You don't use the stochastics. Understand? That, again, it goes back to there's no magical indicator, okay? There's no indicator that's going to be right 100% of the time. Sometimes you're going to get very frustrated with your moving averages, but you have to work through it and continue, okay? The moment that you change it, the moving averages will start working again. Whatever works for you, that is absolutely right, Lindsay. You know, it's not what works for me, okay? It's what works for you and what you can understand. Now, again, this is some of the same stuff I've been telling you already, okay? Start with one of the easy indicators, okay? Start with the EMA or just a simple moving average, you know, and then add to it as you begin to see the patterns, you know. Is it overbought? Is it oversold? Do I need to exit? Okay. And if you can manage to incorporate risk to reward by using the out of the money binaries or by using the touch brackets or the call spreads, then you begin to realize you don't need to be the world's greatest trader. You just need to be right more times than you're wrong, which means you really just need about 55% if you're using risk to reward. Now, if you do have any other questions, you can always email me at tradershelpdesk.com. You can also email me at gm@tradershelpdesk.com. Are there any other questions this morning? Does the information about orders on depth view on Nadex tell you about Nadex volume interest? I don't really look at that, Edward. If I'm going to look at volume, I'm actually going to look at the volume of the underlying, not the volume of the binary or the call spread or the touch bracket.